March 11th, 2026. The International Energy Agency just made the most important announcement in its 52-year history. 400 million barrels of oil from the strategic reserves of 32 countries will be released into the market. The headlines are calling it a rescue. They are calling it unprecedented. They are calling it the right move at the right time. They are wrong about what it means. Nobody is telling you what the release actually signals. Not the price action. Not what it says about the state of the oil market. What it signals is something much bigger. The coordinated release of 400 million barrels is an admission, in public, in front of every government and every market participant on the planet, that the disruption caused by the war in Iran has grown large enough to stop being an oil story and start being a dollar story, a credit story, a monetary system story. And the chain reaction that started in a 33-kilometer waterway between the Persian Gulf and the Indian Ocean is not stopping at the price of gasoline. There are things happening right now in currency markets, in treasury markets, in emerging market debt that most people have absolutely no idea are connected to the same event. This video is about that connection, not the part of the story everyone is covering, the part they are not. If that is the kind of analysis you came here for, subscribe now and drop a comment below telling me this. Do you think the 400 million barrel release actually changes the situation, or is it just buying time? Is less than #0? One hash is greater than I read every single one. Let me start with what most people think happened. War began on February 28th when the United States and Israel launched strikes on Iran. Oil prices spiked because the Strait of Hormuz, the narrow corridor that connects the Persian Gulf to the rest of the world, went from carrying 20 million barrels a day to carrying almost nothing. Governments panicked. The group of 7 energy ministers met on Tuesday in Paris. The International Energy Agency convened an emergency meeting of all 32 member countries the next day. Wednesday, they announced the release. Oil prices fell from nearly $120 a barrel to roughly $90. Headlines called it a success. Here is what actually happened. Oil prices rose more than 25% in 11 days. Brent crude hit $119 a barrel, a level not seen since the Russian invasion of Ukraine in 2022, and that $119 number is not even the main problem. The main problem is the volume. The International Energy Agency's own data says that export volumes of crude oil and refined products from the Gulf region are currently at less than 10% of pre-war levels. Less than 10%. Not a reduction, not a disruption, a near complete stop. Around 20 million barrels a day normally move through the Strait of Hormuz. Iran has effectively closed it. Ships are not moving through. Tankers are sitting. Liquefied natural gas, the gas that heats homes and runs power plants across Europe and Asia, has been cut globally by 20%. Because so much of it moves through the same corridor. And now the IEA releases 400 million barrels and prices fall $30 from $119 to $90. Macquarie, the investment bank, immediately ran the math on what the release actually covers. 400 million barrels is roughly 4 days of global oil production. It is approximately 16 days of the volume that normally transits the Gulf. 16 days. If the strait stays closed, the IEA just bought 16 days of buffer, not a solution, a window. Nobody is covering this part. Everyone is celebrating the price drop. The price drop happened not because the supply problem was solved, but because markets are pricing in a temporary window of relief. The supply problem was not solved. The strait is still closed. Iran is still there. And the IEA executive director Fatih Birol said it himself. In the same statement where he announced the largest emergency release in IEA history, that tanker traffic must resume through the Strait of Hormuz to bring stable oil and gas flows back to the market. He announced the release, and then he said the release is not enough. That is not what a rescue sounds like. That is what an admission sounds like. Now here's the system that most people have absolutely no idea exists, because understanding it is the only way to understand why this oil story is also a dollar story. The world runs on oil. Everyone knows that part, but here's the part they do not teach you. Oil is priced in dollars, every barrel, everywhere, in every transaction, not because dollars are the most sophisticated currency. Not because American oil is the best oil, but because of a deal that was made more than 50 years ago after the gold standard collapsed in 1971. The United States and Saudi Arabia reached an arrangement. Oil would be priced and settled in dollars globally. In exchange, America would provide security guarantees for the Gulf. That arrangement, the petrodollar system, has been running ever since. Most people have never heard of it. Almost nobody outside of central banks and sovereign wealth funds thinks about what it means on a daily basis. What it means is this: every country that needs oil, and every country needs oil, needs dollars to buy it. Japan does not pay for Saudi oil in yen. India does not pay in rupees. Germany does not pay in euros. Every buyer in the global oil market has to acquire dollars first, then use those dollars to purchase oil. Not the aircraft carriers, not the military bases, not the diplomatic relationships. The most important structural mechanism of American financial power is the requirement that to participate in the global energy market, you need to hold and spend American dollars. Now here's what happens when the Strait of Hormuz closes and oil prices spike. Every oil importing country on Earth suddenly needs more dollars to cover its energy bill. Not because they are buying more oil. They may actually be getting less oil, but because the same barrels they were buying last month now cost 25% more, and they have to pay for those barrels in dollars. So global demand for dollars rises. Dollar liquidity becomes scarce. And what happens when demand for something rises faster than supply? The price goes up. And here is the part that runs invisibly. The countries that feel this first are not the richest countries. The countries with the deepest dollar reserves, the United States, Japan, China, can absorb the demand spike. The countries with thin reserves, high oil import dependency, and dollar-denominated debts feel it immediately. They have to buy dollars they may not have, to pay for oil they need to keep running, at a price that has risen 25% in 11 days. That pressure does not show up in the headline oil price. It shows up in currency crises that most financial media in the West barely covers. This is the counterintuitive truth that the mainstream coverage completely missed. The dollar strengthens during an oil shock, not in spite of the shock, because of the shock. The worse the supply disruption gets. The longer Hormuz stays closed, the higher prices stay. The more dollar demand rises. And the more dollar demand rises, the stronger the dollar gets relative to every other currency on Earth. This is already happening. The Bloomberg Dollar Spot Index climbed nearly 1% in the first days after the war began. The United States Dollar Index erased all of its losses for the entire year in a single week. Safe haven demand, oil settlement demand, hedging flows, all of it moving in the same direction. The oil shock is making the dollar stronger. Most people are watching oil prices. The real story is running in currency markets, and it has not started yet. If this framework, that oil shock and dollar strength are not opposites but driven by the same mechanism, is something you have not seen covered clearly anywhere else, subscribe. That is exactly what this channel is built for. And now here is where it gets complicated, because the stronger dollar is not the end of the chain. It is the middle of it. Here is the next link. Oil prices rise. Dollar demand rises. Dollar strengthens. And at the same time, inflation expectations rise. Because when energy costs go up, everything that uses energy as an input gets more expensive. Transportation, manufacturing, food production, heating, cooling. The price of oil is embedded in the cost of almost every physical good in the economy. When inflation expectations rise, interest rates rise with them. Not because the Federal Reserve does anything. Before the Fed says a single word, bond markets start pricing in a world where inflation stays higher for longer. Treasury yields go up. The yield on the 10-year Treasury note, the benchmark rate that mortgage rates, car loan rates, and business lending rates are all connected to, starts climbing on its own. And that is when the Federal Reserve faces a situation that has no good answer. The Fed cannot cut rates. If you cut rates into an oil shock, you are signaling that you are willing to let inflation run. You are telling every bond market participant that you are prioritizing growth over price stability. That causes inflation expectations to rise even further. Bond yields go up even more. You have made the problem worse by trying to help. But the Fed cannot raise rates either, because the American economy was already slowing before the war started. United States employment fell by 92,000 jobs in February, before the first strike on Iran. A weakening labor market plus rising energy costs plus higher borrowing costs is a recession, not a soft landing, a hard stop. So the Fed sits, it watches. It issues statements saying it is monitoring the situation carefully and will respond to incoming data. And the market does not wait for the Fed. The market has already moved. This is the mechanism that nobody is talking about. You do not need to wait for a rate decision to feel tighter financial conditions. Higher treasury yields mean higher mortgage rates right now, higher funding costs for businesses right now, less credit availability right now. The mechanical consequence of an oil shock runs through inflation expectations into credit conditions without any action from any central bank. The central bank is downstream of the market. Futures markets are now pricing in almost no chance of a rate cut. Inflation pressure up, growth risk up, Fed frozen. Higher oil prices are another negative supply shock, lifting inflation and hurting growth, putting the Fed in a no-win situation. That is not my analysis. That is the analysis of the economists who track Fed positioning for a living. They are all saying the same thing. There is a name for this combination. When inflation goes up and growth goes down at the same time, economists call it stagflation. The 1970s were the last time the United States faced it at scale. The oil embargo of 73 and the second shock in 79, inflation above 10%, unemployment rising. The Fed eventually broke the cycle, but only by raising rates to nearly 20%, which caused the worst recession since the Great Depression. That is the historical option set when supply drives both inflation and slowdown simultaneously. There is no clean path. The playbook, as one Wall Street strategist put it this week, is pretty much out the door. While everyone is watching the oil price and the headlines, the real damage is running through a channel that most people have absolutely no idea exists: emerging markets. Here is how this works. Most developing country governments do not borrow in their own currencies. They borrow in dollars. International investors prefer dollar-denominated bonds because dollar bonds do not carry exchange rate risk for them. So governments across Africa, Asia, and Latin America issue debt in dollars. They commit to paying interest and principal in dollars for years, sometimes for decades. When the dollar was weak or stable, this was manageable. You generated local currency revenue, converted it to dollars to make your debt payments, and the math worked. When the dollar strengthens rapidly, which is exactly what is happening right now, that calculation breaks down. You need more of your own currency to buy the same number of dollars to make the same payment. Your debt burden has just gotten heavier in real terms without your interest rate changing by a single basis point. Think about what that actually means for a country like Egypt, which holds a significant portion of its external debt in dollars and has been managing a fragile currency peg. Or Pakistan, which was already in an international monetary fund program before the war started. Or Turkey, where dollar debt is embedded throughout the corporate sector. These governments and companies do not get a phone call saying your debt just got more expensive. It happens automatically, mechanically, the moment the dollar strengthens. The exchange rate moves and the burden increases. The South African rand fell more than 4% against the dollar in less than 2 weeks. Emerging market currencies broadly fell around 2%. The rand is among the worst performing emerging market currencies since the war began. Not because South Africa did anything wrong. Not because its economy deteriorated. Not because its government made a mistake, but because oil is priced in dollars and the dollar went up. They said this was a Middle East war. They said the risk was regional. The mainstream coverage completely missed that the mechanism transmits globally through the dollar. Every country that holds dollar-denominated debt is feeling the war in Iran on its balance sheet right now, without a single missile having landed anywhere near its border. If this analysis is giving you a framework you did not have before, hit the like button and share this with one person who is trying to understand what is actually happening in markets right now. Not the noise, the mechanism. Now here is the layer that almost nobody is covering, and it is the one with the longest tail. Oil shocks do not stay in commodity markets. They migrate. They always do. The mechanism is margin compression. When energy costs rise, every company that uses energy as an input starts paying more for the same output. Not oil companies. They are benefiting. Every other company. Airlines paying more for jet fuel. Shipping companies paying more for diesel. Manufacturers paying more for electricity and raw material transportation. Chemical companies, packaging companies, food producers, consumer goods makers. These companies have two problems at once. Input costs are rising, and borrowing costs are rising with treasury yields. A significant portion of corporate lending right now, particularly in the mid-market, the companies too large to be small businesses, but too small to access the bond market easily, sits in private credit, floating rate loans. Not fixed. Floating rate means the interest rate adjusts as benchmark rates move. When treasury yields rise, those loans get more expensive automatically, no decision required. The rate resets and the cost goes up. Analysts at Allianz projected that in a stress scenario, not a catastrophe scenario, a moderate one, middle market lending spreads could widen from around 500 basis points to 650. That widening translates directly to a company's cost of debt service. If you are a mid-sized manufacturer already absorbing higher energy costs and a slower consumer who is spending more on gasoline, a jump in your borrowing cost is not an abstraction. It is the thing that determines whether you keep your current headcount, and this pressure does not announce itself. It does not show up as a crisis headline on March 11th. It accumulates, quietly, one company at a time. Hiring freezes first, capital expenditure delays second, employment numbers third. By the time it shows up in the data, the chain started months earlier in an oil price move that most people stopped paying attention to. Not the banks, not the hedge funds, the actual companies, the ones that make things, the ones that employ people, the ones whose earnings eventually support equity valuations. That is where the slow pressure is building. So let us go back to 400 million barrels, and let us say clearly what it means and what it does not mean. It means that the coordinated response framework built after the 1973 Arab oil embargo still functions. 32 countries agreed unanimously. That is not nothing. In a world of competing interests and fragmented policy, unanimous emergency action within days of a crisis starting is genuinely significant. What it does not mean is that the supply problem is solved. 400 million barrels sounds large. The previous record was 182.7 million barrels, released after Russia invaded Ukraine in 2022. The new release is more than double that record. More than double. In the history of the IEA. An organization created precisely for situations like this. They have never done anything close to what they just did. And they did it because they had to. The Strait normally passes 20 million barrels a day. 400 million barrels divided by 20 million barrels per day is 20 days. If the Strait opens in 20 days, the release covers the gap. If it does not open in 20 days, the world has to decide what comes next. And the IEA does not have unlimited reserves. Members hold roughly 1.2 billion barrels of public emergency oil stocks. They just committed 400 million of those, roughly a third of the public emergency buffer, in a single move in the first 2 weeks of the crisis. You deploy a third of your emergency reserve in the first 2 weeks of a crisis, and you are not telling markets the situation is under control. You are telling markets the situation is serious. You are also telling markets that if this continues, the next decision is harder, because the next release comes from a smaller stockpile. The safety net gets thinner every time you use it. The oil price fell from 119 to 90, still 25% higher than 11 days ago. Tankers are still not moving through the strait. And Iran's foreign ministry statement said, not a single liter of oil will pass through the Strait of Hormuz for the benefit of the United States, Israel, or their partners. That is not negotiating language. That is a position. And positions like that do not resolve in 16 days. So here is where we actually are. An oil shock that started as a commodity event has become a dollar event, an inflation event, a rates event, and a credit event simultaneously. The reserve release bought a window. How long that window lasts depends entirely on whether the strait reopens and when. The Federal Reserve cannot cut, cannot raise, can only watch. The dollar is stronger in ways that are quietly increasing the debt burden of governments across the developing world. Corporate borrowing costs are rising for companies that never had anything to do with oil or the Middle East. The consumer is paying more for every gallon and every delivery and every flight. And the IEA executive director, in the same press conference where he announced the largest emergency action in his organization's history, said the solution is not in the reserves. The solution is in the strait. Nobody told you the rescuers said the rescue is insufficient. They said this is an oil story. Most people have absolutely no idea that the price drop was a window, not a resolution. That the chain reaction from oil to inflation to yields to dollar to emerging markets to credit has not reversed. It has paused, and a pause is not the same thing as an end. Here is something that history keeps demonstrating over and over, that markets consistently refuse to believe until it is too late. The first shock is visible. The secondary effects are invisible until they become undeniable. Everyone saw oil go up in October 1973. Almost nobody understood in real time that the combination of oil price, dollar dynamics, and Federal Reserve indecision would produce a decade of stagflation. Everyone saw the subprime mortgage failures in 2007. Almost nobody understood that the secondary mechanism would produce a global financial system that came within days of complete collapse. The first shock is a warning. The secondary mechanism is the actual event. You are watching the warning right now. Here's the question I want to leave you with. The chain is running. Something in it breaks before the others. It always does. The emerging market currencies that are silently becoming more expensive to service. The corporate credit markets, where floating rate borrowers are absorbing two cost shocks at once. Or the Federal Reserve itself, which will eventually face a moment where it has to choose between the inflation and the growth. And whichever it chooses will be wrong. Which link breaks first? These are not rhetorical questions. They are the questions that determine what the next phase of this crisis looks like. Whether it stays a war story or whether it becomes a financial story that outlasts the conflict by months. Oil markets have a history of resolving faster than the secondary damage they create. The strait can reopen, the price can fall, and the credit tightening, the emerging market stress, the elevated inflation expectations, those run on their own timeline, independent of the waterway. So, Think about what you are actually watching right now. Not the oil price, not the news about the Strait. Watch the dollar index. Watch emerging market currencies. Watch where credit spreads are going in the corporate mid-market. Those instruments tell you whether this stays manageable or becomes something else. The headline story ends when the war ends. The mechanism does not necessarily follow that schedule. Which one breaks before the others? And do you think the markets are paying close enough attention to see it when it does? Subscribe to this channel if you want to understand the mechanism before the headline narrative forms. Because the window between when the data starts moving and when the mainstream coverage catches up is where this kind of analysis is most useful. Like this video if the analysis shifted how you read what is happening right now. Leave a comment with your answer. Emerging markets, corporate credit, or the Fed, which breaks first? I read every single one. Share this with one person in your network who is watching markets right now and would benefit from the mechanism, not just the headline. That conversation is worth having.